Investors who buy time. A compounding, optionality, and behavioral perspective. Most investors try to buy assets. A smaller group tries to buy something more powerful. Time. Buying time means structuring capital, risk, and behavior so that you can remain invested long enough for compounding to work. In markets, survival is leverage. Time is the multiplier. 1. What does buying time mean? Buying time in investing means extending your holding period, reducing forced selling risk, lowering emotional volatility, protecting compounding continuity. It is not about speed. It is about durability. Investors influenced by Warren Buffett often emphasize permanent capital, capital that does not need to be withdrawn during volatility. Permanent capital buys time. 2. Compounding rewards time disproportionately. Compounding is nonlinear. The majority of wealth accumulation typically occurs in the later years of sustained growth. If you interrupt the process through panic selling, excessive trading, over-leveraging, liquidity stress, you lose not just money, you lose time runway. Buying time means protecting the runway. 3. Financial buffers as time purchases. Liquidity buys time. Emergency funds, low leverage, and controlled position sizing prevent forced decisions. Without buffers, market downturns create urgency. Urgency forces sales. Sales break compounding. With buffers, volatility becomes tolerable. Patience becomes possible. Time is often purchased with liquidity. 4. Optionality, the strategic advantage. Optionality means having choices without obligation. Investors who maintain cash reserves, diversification, low fixed financial pressure, gain the ability to act when opportunities arise. Optionality extends time flexibility. Instead of reacting under pressure, they wait for asymmetry. 5. Behavioral stability extends time horizon. Research by Daniel Kahneman shows that frequent evaluation increases emotional volatility, myopic loss aversion. Investors who check portfolios less frequently, avoid constant news consumption, automate contributions, reduce emotional interference. Less emotional stress equals longer holding capacity. Buying time is partly psychological. 6. Avoiding leverage to protect time. Leverage compresses time. When using high debt or margin, small price movements can trigger forced liquidation. Holding period becomes externally controlled. Investors who avoid excessive leverage preserve the ability to wait. Time disappears when leverage forces decisions. 7. Career and human capital as time assets. Financial capital is not the only resource. Stable income streams extend investment runway, risk tolerance, recovery capacity. Human capital buys time during downturns. Investors with stable income can continue investing during recessions, effectively buying future compounding at discounted prices. 8. Identity and time ownership. Investors who view themselves as owners, builders, allocators, naturally think in decades. Investors who view themselves as traders, market timers, short-term performers, compress time into weeks or months. Identity shapes time perception. Buying time often begins with changing identity. 9. The strategic mindset shift. Short-term investors ask, how fast can this grow? Time-buying investors ask, how long can I stay in? That single shift changes risk management, position sizing, emotional response, portfolio structure, the core insight, markets reward, survival, consistency, endurance. More than speed, time amplifies good decisions and forgives temporary volatility. Investors who buy time protect liquidity, reduce leverage, lower trading frequency, maintain optionality, strengthen psychological stability. In the end, you don't get paid for activity. You get paid for staying in the game long enough. Time is not just a variable in investing. Time is the advantage.